their accountant might say, oh, rent out your house for 14 days or 13 days out of the year, and you don't have to pay, you don't have to report the income on these short-term rentals. And that's true. That's fine. But you got to keep the documentation. You got to prove it. You got to be able to show exactly what's going on and demonstrate what the facts and circumstances are of your case. Any of this stuff is good. There's no doubt about that. The key to it is documenting your position.
You mentioned there's different ways to document. I believe it's in the small business book. There's five methods like contemporaneous logs or something, receipts, Amex bills, and there's confusion around this where I've even heard people lose audits because they didn't have a receipt. And you say, well, that's not true. They could actually reconstruct it ethically.
First of all, the IRS will say, well, you have to have a receipt to claim this deduction. Okay, you give them a receipt and they say, well, now you need a receipt and a canceled check, both, to claim this deduction. That's how they trap people, right? That's what they do to bluff people out of the deductions and to get them to agree that, yeah, I must have made a mistake on my tax return and now I owe you all this money. There's six different ways to prove deductions, and these six different strategies can be used separately or together as combinations, right?